Hello everyone. Okay, I'm Wildicha and welcome to my YouTube channel. So this is on the topic of cash flow statement, and this is part 1 of the whole series. I think this will be interesting, especially for students taking this at the degree or diploma level, especially if you're doing like financial accounting. Let's begin. So the scope today is basically introduction to cash flow statement and to understand and explain the underlying logic underlying the preparation of cash flow statements. And we'll use a very simple example to illustrate how to prepare a cash flow statement. But this is a very simple example, right? If you already know this, then you could pass by this video. Okay, then we look at a bit of the limitations of cash flow statement and we'll close for the topic. Okay, now I had a very interesting chat with a colleague on this, and my colleague, he posed me this question, right? He said that, what is the difference between cash flows and profits? I had that look like that. I was looking at him. You sure you asked me this question? And it is the same question that comes up, once every now and then. And students as well ask this question all the time. What makes them so different? So what I did was that I went on to talk to my colleague, and then I showed him this very simple working. I said, what if you have a business where everything is cash based? All sales are made and collected in cash. All purchases are made and also likewise paid out in cash immediately. No credit terms. Now, in such a case, the net cash flow at the end of the day should be 1,200. So therefore, if you were to look at the income statement of a business, right, since all these items are on cash basis, the income statement should look exactly the same. It should be. So it would be identical. Right, in such a case where everything is on cash basis, we say that therefore the result of cash flows and the result from accounting profit should be exactly the same. Right, but however, there is an issue. Cash basis of accounting is somehow different from the accrual basis of accounting. Why? Well, say for instance, you have performed and closed sales of 2,000, and that, say for instance, not all customers paid up. Only $1,200 have been collected. Now this changes the situation a bit. The cash flows are lesser. Why? Because although goods have been sold for up to 2,000, collections are far lesser. Observe, there is an obvious difference between cash flows and accounting profit. Now, so where you have situations like, for instance, credit sales, this will surely result in differences between cash and accrual accounting. Okay, so it's not just cash sales but also credit transactions. And this is a real problem. So as a business person, as an accountant, right, it's important to understand why is it that cash flows are different from income statements. Well, and to be able to understand this, then one has to understand that the difference between these two, right, is due to the presence of a credit transaction. Now, some other causes of this include provisions. Provisions for doubtful debts may also affect the, may also cause cash flows to be different from accounting profits. Okay? So, if income statement doesn't tell us cash flows, then what does it do? It simply tells us revenues and expenses that arise within a period, but not payments and receipts. So payments and receipts, and when they occur, is not reflected in the income statement. So in fact, cash flows would therefore have no relationship with accounting profit. The business may have good cash flows but have no profits, and the business may have no cash flows but profits may be extremely attractive, right? So income statements doesn't give any indication of cash flows, and truth is that, in other words, there is no correlation between the two. Yet it is important to understand how cash flows are in order to be able to understand how the business is really doing, right? So what are cash flows? Cash flows may arise from many sources, such as sale of goods, proceeds from loan, proceeds from disposal of assets. It may arise from payment of goods and services, repayment of loans, and purchase of assets. So it may occur from many other sources and so on. So, but generally we classify cash flows into three broad categories: operating, those that occur during ordinary course of business, which includes sales and purchase of goods and services. Investing cash flows arise due to investments and liquidation of assets, right? So the examples include, as mentioned here, acquisition in new assets or disposal of old assets. Financing cash flows may arise because of additional financing obtained or payments to providers of finance. This may also include dividend payment and also interest payments, right? So those are the broad three categories. Now we're going to use a very simple example to illustrate how a simple cash flow statement is prepared. Now the format of preparation may differ depending on where you're taking this at, okay? But anyway, I'm going to use a generic format to show you how the cash flow statement is prepared. So in this case, A Limited closes its books at 31st December. Following shows the income statement for the year ended December 31st, 2014, and you have the balance sheets for the 2 years 2013 and 2014. Okay, and our job now is to simply prepare the cash flow statement for year ended 31st December 2014. Assumptions are all transactions on cash terms, no credit transactions, no purchase and or sale of capital assets. Fairly simple. So let's go on and prepare this. Okay, so the cash flow statement should begin with a very simple heading. The heading is very important because it shows to the user when does it apply to. So this is the cash flow statement for the year ended 31st December 2014. Okay, so there are three broad categories. Alright, so we have the cash flows from operations. Right, so let's have a look. Right, in this case, there are sale of goods. There is no change in receivables, so that's fairly simple. So that means the collections for the period must have been 2000. Right, so the collections from receivables or cash sales is 2000. Payments. There are basically two payments. One is purchases and the other being operating expense. In this case, in this question, there is no depreciation, so no worries about it. So payment, next item is payment for goods. Right, payment for goods, there is only 1002. Payment for operating expenses, which is basically 400. Net result gives us 400. So the 400 is the net cash flow. Okay, from operating activities. So that's very simple. Alright, now it is simple also because we know for sure that there are no credit purchases, as you can see here. No credit purchases. That's why I could confidently emphasize to you that the purchases are on cash basis, so are the operating expenses. 2. The following section is the cash flow from investing activities. Now this is quite straightforward. In this case, there isn't any. Now investing activities can be uncovered by referring to the non-current assets. As you can see here, there is no change, is constant, and that the instructions mentioned to you that there were no purchase or sale of assets. So that makes it very simple for us. 0. 3. Then 3, we have the cash flow from financing activities. So let's observe here, there are no loans, no additional capital taken from shareholders, and there are no indications of dividends paid. That's fine. So that is also 0. Now in this case, 400 plus 0 and plus 0, that tells us that there is a net increase in cash. Okay, net increase in cash. Now in some textbooks you also continue to add and cash equivalents. That depends on your course. Alright, so opening balance of cash. In 2013 we have closing balance of cash 150. Right, so opening balance of cash, that gives you 150, total 550. So 550 should be the closing balance of cash. Now this number 150 comes from 2013, 550 comes from the number in 2014. Now how will we know if this is correct? Simple. Let's go back and verify. 2014, the number is indeed 550. So we have done all that, and then this is a very simple cash flow statement, right? Nothing too complicated, but obviously if you're taking this in the exam, it can't be that simple, right? Okay, so that does it for the cash flow statement. So the realities are that transactions don't occur on cash basis. The fact is that there are transactions that occur on credit basis, those where goods were taken but payment not made, payment to be made later. Non-current assets are indeed purchased and sold from time to time, right? And in my example, this has not been taken into account. Financing activities likewise do occur, but then in my example wasn't illustrated. So cash flow statements are fairly simple in helping us to uncover causes of weak cash flows, like where are the cash flows coming from, right? So this is useful in assessing financial performance, and well, basically what we have done now is that we have covered the direct method. Okay, so basically this is derived by taking sale collection minus payments. Fairly simple. So the format may vary depending on the course that you're taking, and also the applicable financial reporting standard. Right. Thank you for watching. So that concludes the part 1 of the video, which is quite simple. When it comes to part 2, we'll look at the more advanced concepts. And meantime, I'm Will Cha, and you have been watching this on my YouTube channel. Thank you.